existing product, existing services which you are going to sell or which you continue selling into your market, right? The advantage is, unlike the market sizing, you have past year data, right? You know that for the last 5 years or 10 years or for how long you have been in that market, right? What is the sales, like how much revenue you get, right? So that is where you have certain base. You know that, okay, let's say for if you like, let's say automobile component manufacturer, for last 3 to 4 year average sales has been 25 crores or 30 crores per year. Last 2 years, maybe due to COVID, the numbers has declined to 10 or 15 crores. So that is somewhere he has to, like, COVID has a factor he has to take into consideration. So he has to expect that. So that is where he will have certain kind of potential sales, put a standard, okay, what kind of sales he or she is expecting, that company is expecting next year, and different factors, how much sales effort they have put, right? How much kind of marketing promotions they have done, right? Even after that, there will be always this kind of scenario, calamities like flood, fire, or this kind of COVID pandemic scenario, right? Which will disrupt whatever plan you have, right? But having said that, you will always plan for the future, right? That is where the forecasting comes into picture. Forecasting is not nothing but based upon your past data, based upon the information what you have with you. Can I predict the future? Can I estimate the future, right? Can I estimate the number about the future, right? So that is where you divide again based upon your customer forecast, each customer, because we are talking about B2B, right? Most of the times what happens, the companies, let's say if it is automobile component manufacturer, let's say MRF. In India, there are 10 to 12 automobile manufacturers, right? So out of that, you might be supplying your product to 5 or 6 of them, right? Not all of them, obviously. So you know that customer-wise, what is the sales or how much revenue you are expecting. Product forecast, you might have different tire for different kind of cars or different kind of automobiles. So for different product, how much sales you are expecting. Then territory, region wise or sales territory wise, how you have defined your territory, right? You are try to forecast those, right? You try to understand that what will be your market share. Again, depending upon your product life cycle or the kind of what kind of, whether it is a new product or it is already mature product, it is going to be discontinued, right? So again, that forecast will vary, right? Because if it is a new product, you will be putting a lot of marketing investment, sales investment. If it is already matured product, it is after 1 year or 2 year, you will discontinue that kind of product, right? So you will have less marketing effort or sales effort on that, right? So based upon that, you will think of what is your return on investment, how much money you are getting out of that market, right? So all of that based upon your sales investment, based upon your sometimes what might happen that distribution channel partners might ask for more money, but they might switch, they might get into the different competitor, right? So those are the few challenges or few angles you have to think of, and that happens a lot in FMCG companies, right? If it is a bigger distributor moves away from your kind of company, right, you will make a huge loss that year, because getting a big distributor is a big challenge for most of the companies. So based upon that, you make a expected sales. Then every year you will have a standard which your CMO or CEO makes, because see, at the end they are just a CEO or a CMO, a chief marketing officer or a chief executive officer. They will be judged by what is the revenue growth of a company, right? Board of directors will not like a company to be stagnant, which is not growing, because again, that depends upon your share value, your market capitalization, your return to the investors, right? So you have to present what are your plans to cover, or let's say last 2 years, most of the companies are into red, apart from few companies who are selling those health related products. So they have to have a solid plan to recover the sales, to recover the revenue, right? And that is what you think about, like how complex the process is. As a sales officer, you might just look into few distributors or few dealers in your region that will get together at a regional level or at a state level, that will get together at a territory level, that will get to the head office. In head office, they will do certain calculation. Then that calculation they have to present in board of directors meeting or the like management meeting every quarter or every maybe every 6 months down the line, right? And every time you have to make sure that you do not kind of, obviously there will be mistake, but the range should not be great, right? Just imagine a scenario you have, and it happens a lot in B2B, because in B2C, what happens? You know that tomorrow, if you are not meeting the kind of target, you might provide a little bit of discount, or you might start kind of providing little incentives to your dealers or distributors. You might reach the target. In B2B, what happens? Your number of customers are less. Suddenly, you are not growing your customers. You have maybe 10 or 12 or 15. Think about MRF, think about those tire companies. Suddenly automobile sales crashed, nobody started buying cars, and the tire kind of the like kind of automobile manufacturers also must have stopped buying tires, right? Buying the components for cars, or at least would have reduced the number of tires they used to buy 2 years back, and now how much they are buying. Obviously it will be less comparison to last 2 years. So how to deal with those situations? It is not that if you start giving discount, they'll start buying the number of tires more, right? It won't happen in that scenario. So that's why it is a tricky situation. Number of customers are less. Number of opportunities, it is not that suddenly. It is a long sales cycle, right? So that always the question happens: what is a short sales cycle? What is the long sales cycle? Most of the times, B2B sales is a long sales cycle. It takes at least 6 to 9 months to finalize a deal, minimum, right? It might get into, if it is a bigger revenue or big number, it might get into 18 to 24 months also, right? So you have to wait, you have to kind of be persistent about selling your product or services. Then obviously at the end, actual sales might happen, and it might be completely different from whatever you have assumed or whatever you have anticipated, right? And last 2 years for most of the companies, that has been the situation. Now, having said that, knowing that that will be always certain error associated with our forecasting, because forecasting most of the times based upon either qualitative, we take whatever our salespeople tell or whatever the experts tell, or little bit of quantitative based upon your past data, right? In either way, whether I believe on human judgment, whether my salespeople are telling the truth or being honest about how much actually they can sell, or if I just believe my past data, last 5 years or 10 years, I have been doing this kind of sales. So projection will be according to that, right? In either way, or if I mix them both also, there will be certain error associated with it. And there are many ways to kind of evaluate or calculate those kind of errors. The idea is, as long as your error is between 5 to 10 percentage or 15 percentage, right? You are okay with your because everybody understands sales forecasting cannot be 100% accurate. The point is how close your accuracy is, right? Whether you have targeted or you have estimated expected sales to be 100 crore and you just got 50 crore, right? Then you are way beyond your target, way below your target. Or you have anticipated 100 crores, you have able to reach 80 to 85 crore, right? Then still it is okay, right? So that is why there are different methods of forecasting. Different companies, depending upon how much effort they can put, how much, whether they have that kind of investment, you can use complex techniques, complex strategies. Lot of B2C companies do that. But in B2B, like I said, the number of customers are less. Most of the times, the account managers. So it basically how big accounts you are handling and what is your strategy, how much sales you are expecting. Right? They most of the times, again, some companies still do a lot of complex forecasting. It is basically they will be using this kind of Salesforce composite or a executive judgment. They don't get into a time series or regression, right? That will be much more useful for a FMCG or a B2C company. Again, it is not that not B2B companies do not use that, but they prefer most of the time Salesforce composite because it is easy and it makes sense because number of customers are most of the times are less, 50 to 100 maximum, right? For that, doing a complex analysis doesn't make sense, right? But anyway, we'll go through little bit of to understand what are those. In other courses also, you might have covered that, so it will be again repetition of these techniques. Executive judgment. So first, qualitative. Qualitative is basically based upon the human judgment, right? There are basically three parts: executive judgment, Salesforce, composite, and Delphi method, right? So executive judgment is basically at a higher level estimate. So your marketing director, your CEO, CXO, plant managers. So one key role played by the plant manager based upon the manufacturing estimate. So they know that last year they manufactured this many products. So this year, what will be the plan or whatever the kind of manufacturing plan they have. Similarly, marketing director will come and talk about what kind of sales investment or marketing investment they have done. Based upon that, those executive team, so basically all the CXO level people, right, get together and do a estimate. Okay, last year we had done this kind of sales and what kind of estimate we have. So they will have their own experience. They might take certain expert opinion. Based upon that, they will. So this is a very high level estimate, right? So and most of the times it happens like that. So let's say talk about MRF. MRF might not be employing this executive technique, but just to give an example, they will tell that okay, last year we did a sales of 80 crore. So this year, I think the automobile sales are gaining up. People have started buying cars. There is an increase in demand. So these are certain positive economic indicators. So each of them will give an estimate, and if they average it out, let's say it comes to 100 crore, right? Then 100 crore based upon the ratio they have uh, kind of calculated last year, like not calculated, based upon region wise, how much kind of sales has happened. So they will divide, okay, western region 40%, eastern 30%, northern and southern part this many percentage, right? So think about in this way, somebody in the board of directors or the executive team is fixing the target, and it will trickle down to a sales officer who is in the ground, right? So from the top level, somebody sitting in a AC room, they might not have the actual kind of, though some of the times they do have, because most of them are from the sales background. They might just tell that, okay, yes, it is possible to get 100 crore sales this year, right? And they'll just give that target to the territory, from territory to the region, from region to the states, from states to the district. Suddenly, one evening, you will get an email that, okay, next year for your district or next year for the 2 or 3 districts you are handling, the sales target is 1 crore, right? Suddenly you will be surprised that last year I only able to, after such effort, I just put 50 lakh sales and now I have got a target of 1 crore. How is that possible? Right? It is not at all possible, right? And most of the times conflict happens due to that. The sales forecast comes from the top down, from the top team, executive team, the sales kind of estimate or the forecast will come to the like field sales officers who are in the field, right? So that's why it is always better to kind of take the opinion of Salesforce who are in field. That is where your Salesforce composite comes into picture, right? Combining and averaging individual salesperson estimate of future sales, because they are close to the reality, they are close to the ground, they know better, they will have better estimate than somebody who is just sitting at head of it. Right? They might have 15 years, 20 years, or 25 years of experience, but these people who are in the ground, right? They might have much more good information, relevant information about the sales, right? Uh, Only concern is that kind of sometimes what happens, just imagine like if I ask you to put a target date of your presentation, your marks, right? Everybody will be kind of try to play a little slow, right? You'll tell that okay, I'll take okay 3 months to complete this presentation. I'll like kind of, and it is a human nature, right? If ask you to give you a target, right, you'll always put a lesser target, right? And that is one challenge the executive team has. If they just give the sales team to put a target, obviously no salesperson in his sane mind will put a, if they have made a sales of 50 lakhs last year, no, none of them will put a 1 lakh 1 crore target for next year, right? Even the market is good, even the estimate is good, rather than they put a target of 40 lakhs and get a actual sales of 1 crore, then they can say that okay, I overachieved, right? And that is a human nature, always happens. We try to keep our target low and achieve more than that. So most of the time, that's why companies do like compositor, do both of them, take the top down estimate, what is the target given by the executive team, and what is actually the sales team in the ground thinking of how much they can achieve, right? And they try to balance them. They try to take certain ratios and try to balance them, right? So that both of their opinion are taken into consideration. But that depends upon the company's executive, whether they are really interested to take the opinion of salesforce who are on ground, right? Then next is Delphi method. This is an interesting one. What happens again? It need not be necessarily your own employees who are making the forecast. Some of the times, what happens when you are launching a new product or service, right? As a company, or you are getting into a new market, let's say a foreign company, European or USA company getting into Indian market. They might not have correct idea about Indian market, right? What is the estimate or what are the for the current existing product, right? So they generally take the help of these experts. So they will do the survey. They will like get a few experts along with their sales team, and each of them will try to give an estimate, right? Okay, this is the like kind of market share or this kind of sales or revenue you can expect next year. So let's say there are three experts along with two of the sales directors. Each of them gave their own estimate and obviously justification around it. Somebody will sell 20 crores, somebody else will tell 30 crores, somebody will say 10 crores. So like that, they'll give their own justifications. After the first round gets over, then again they will discuss why somebody told 20 crores while somebody else have given a target of 35 or 40 crores, right? So discussions will keep happening till they agree upon based upon the common agenda, common like kind of justification point. Okay, we believe as a team, six of them, three experts, two sales directors, and the CEO, they believe that the sales target will be let's say 22 or 23 crores, right? So that is a Delphi method where each of them kind of give their own target, give their own justifications, and it is a round robin, right? Each of them have a chance to talk about that, and it keeps happening. Hello.
देखते आगुरी तो बेशरम थिला तपर अविनाश ये कला पर आंगला उला कि टिके सुधरी जिवो कि आहुरी बरबाद है यार
Smita, keep yourself on mute.
चिपलिमा મને ચિકમગલું સૌરે માને પડે બલજીત
Okay, so now coming back to Delphi method. Delphi method can be done through two different ways. One is verbal, when people get together and talk about what kind of estimate they are doing for next year, or it can be written also. Sometimes what happens, there will be a CEO there, or there will be one expert who will tell that no, my estimates are correct. I say 35 crores means 35 crores. My justifications are correct, right? So in that case, what basically they do, they keep that in written, and once they give in writing, they have to like kind of, they cannot change that, right? Later on they might not be able to take it back, right? So then once they give in writing, then again the whatever they have given written justifications will be circulated. Again all of them have to agree. So in both the cases, whether written or verbal, both in all the cases in Delphi method, as a group consensus, they have to agree on an estimate how much sales this team is expecting or giving to the sales force, right? So that is how these qualitative techniques happen. So where you can use executive judgment, mostly kind of 1 to 3 year of your sales estimates, existing products. Again, it is a ballpark estimate. It cannot be exact because you do not have the idea of actual sales force who are on field. Salesforce composite, mostly it is used when you have a account management team. There are few sales people who are managing accounts because they are close to the ground. They exactly know that how much sales will happen. For a company like MRF, this will be much more beneficial because at most there are 8 to 10 Indian manufacturers of automobiles. So they know exactly what will be the kind of sales figures for each of those automobile manufacturers. Third one is Delphi method. Delphi method is mostly will be used whenever you are launching into a new market or getting into a new product or services sales. Right? So that is how these qualitative techniques work. Any questions on this? Any questions on the qualitative forecasting? Okay.
So what is the difference between executive judgment and the Delphi method?
Executive
I
judgment
confused.
is your own company's executives. 99% of the times, these are your people, your CEO, your CMO. Delphi method, most of the times, it is outside experts, kind of along with your sales team, along with your top management.
Okay, sir.
So that is why whenever you need to get into a new market or you are trying to sell a new product or services, right? You get into this Delphi method. And there are experts actually who charge for a, so I forgot that kind of. So there was a diaphragm pump, double diaphragm pump, which we built for the Indian market, right? And we did not have any idea about what will the market estimate. So we took a help of market research company through which we did this kind of interviews. I think they per session they used to charge around 800 or $1,000. So the sessions used to for 2 to 3 hours maximum. So each expert we used to pay. So we used to pay to that market research company. I'm not sure how much they used to pay to those consultants, but per expert we used to pay 800 to $1,000. So we took help of around 5 to 6 experts. So around 5,000 to 6,000 rupees. Sorry, $6,000 we spent. So that is where you take the help of outside experts to get into a kind of a consensus. Any questions on this? Okay. Next is quantitative forecast techniques. The simpler one is time series. It is basically your kind of past data, past sales figure, trend line. You draw the trend line, seasonal patterns, cyclical patterns, right? So you try to understand because there will be some product which will be have seasonal kind of requirement, right? Some let's say think about the paint manufacturer, those people who are supplying different paint to automobile companies, right? So they might have little bit more requirement after rainy season, because after rainy season people are kind of that in service centers, people looks like they used to or want to repaint their cars or automobiles, right? So that depending upon, not all the products will have seasonal or cyclical patterns. Some products might have seasonal or cyclical patterns, right? So those things you have to consider in your sales forecasting. Other one is regression. Regression, as you know, that my dependent variable will be sales, and I have to find out the correct independent variables, right? So here the example is how many housing furniture sales, right? If I want to, let's say I have a company and I sell office furnitures, right? Or I sell furnitures to different malls, different big malls and kind of stations, right? So depending upon number of projects, number of housing project, number of malls being built across Bhubaneswar, across Odisha, or across India, right? I'll be able to project what will be my furniture sales estimate, right? So that is where I can build a regression model also. But the problem is getting that data. If I do not, let's say I'm a like I have a startup, I might not have previous year's data, right? So I have just started the company 2 3 years back, so my sales would have been very slow, right? I might not have exact figure, right? uh, Talking about regression, finding the correct independent variables. Let's say if I'm selling furnitures to offices, how many offices or how many office complexes are being built across India at a point of time? Getting that data might be challenging, right? So that is where like getting the so regression on paper looks easy, but getting the details, getting the information about those variables is pretty difficult, right? So that's why most of the people go through the time series way. Last 5 years, 10 years, I have this kind of sales, so I can just set a trend line and I'll make that kind of sales next year, right? So accuracy wise, I believe that regression will be much better if I am able to get good predictors, good independent variables. But getting those information is pretty difficult. That's why most of the companies get into time series. But like I said, these quantitative forecasting techniques mostly used by B2C companies, right? In B2B companies, people most of the times go through these qualitative techniques for the sales force estimate. Any questions on this?
Sir, I'm getting confused between seasonal patterns, cyclic patterns, and irregular patterns.
Okay, irregular patterns which you can predict, not predict actually. So though it is written patterns, suddenly let's say COVID happened, right? There is a decline. Then after 3 or 4 years, something like this might happen, natural calamity, right? So it is not regular. So it will not be prudent to talk about the pattern. Cyclical means based upon your economic cycles or based upon your business cycles, right? You have launched a new product, so you know that your sales will grow. After 2 or 3 years, when product gets into matured stage, sales will decline. So that is based upon your product launch cycle, or it might be due to your economic cycles. Now the there is economic growth, so sales of your product or components will increase. People will start buying automobiles, so demand for tires will increase, right? So that is where cyclic, like we are getting into the top of the cycle. But after 3 years or 5 years, so economic cycles are basically 3 to 5 years. There will be growth for 3 to 5 years, then there will be stagnation, there will be decline, then again there will be growth, right? Like it happens in stock market or any economy. So that 3 to 5 years sometimes might get extended to 7 to 8 years. That nobody can predict. If somebody can predict, they will be like a kind of earn money like anything. But that is the most difficult part. What will be exact cycle of whenever deflation happens or inflation happens? Nobody can exactly predict. But generally, people take economic cycles of 3 to 5 years. So there will be growth for 3 to 5 years, then there will be stagnation, then there will be decline. So that is the cyclical patterns. So cycles can be due to economics, due to your product launch or the business, right? So there are different cyclical patterns. Like I said, you have launched a few products last year, so you know that there will be growth for next 3 to 5 years. Then there will be decline for particular those products, right? So that is where the cyclical patterns comes into picture. Seasonal patterns are basically based upon seasons or months. There will be certain products, certain component which will have a requirement during certain seasons, increase in sales, decrease in sales, right? So that is basically within a year. So seasonal patterns are basically taken into within a year. Cyclical patterns more than a year, up to 3 to 5 years, right? Irregular patterns, like the name suggests, it is irregular, but your past data will show you, like whenever that happens, right, what will be the impact on your sales. You might not predict when it will happen, that's why it is irregular, but you might predict what will be the impact, right? So that buffer you will always have in mind. So let's say COVID happened, on an average, let's say tire sales has declined by 30%. So that buffer you will always have in mind. Any year this kind of pandemic or this kind of situation happens, my sales can get reduced by 30%, right? So that you have to keep in back of your mind. Cyclical patterns, general economic cycle range is 3 to 5 years. Seasonal patterns, within a year, whatever kind of changes happen during seasons, during months. Does it clarify your doubt?
Yes, sir. Yes, sir. Thank you, sir.
So mostly time series, because like I said, it is very difficult to predict economic cycles, right? So mostly it will be useful because seasonal, somebody knows, right? Okay, rainy season, summer season, winter season, air conditioning, right? You know that summer season it will increase. People will keep buying air conditioning systems just before summer season starts. It will start increasing till the summer season exists. Rainy and your winter season, the sales will decline, right? So that kind of estimate is accurate in a short time, right? But predicting a economic cycle, right? It is very difficult to predict that. So that's why it is very accurate. I'll not say very accurate. The accuracy is better than long term. In the short term, it is a little bit more accurate than the longer term. If I'm predicting for next 1 year, I can basically use a time series model. But if I'm predicting for next 3 to 5 years, I have to look into certain regression models. But the challenge with regression models is getting correct data, which is difficult to get without proper market research. Then there is something called collaborative planning, forecasting, replacement. So that is where, so if you see till last slide, right, whether it is qualitative or quantitative, sales team was the main driver, right? All the information will come from the sales team. Those CEOs, plant managers will be involved, right? Most of the times it is the CMO or the chief sales officer who takes the decision, right? Because they take the, okay, this much sales we are expecting, or this much revenue we are expecting, right? So that is where other functions do not, though they play a certain roles in executive judgment, it is not the sales director or the sales chief sales officer makes the final decision. There will obviously CEOs, plant director or plant manager involved, but again their involvement used to be low. So that is where later on this kind of method from 1980s to 1985. So this kind of method was much more popular. Till now also most of the companies use that. So collaborative planning, forecasting, replacement, or CPFR is when you keep your, like, so that is where the ERP system is much more required, right? Earlier what used to happen, people or the companies do not share data along with their channel partners. Their own distributors, dealers will not have an idea, or will not have the details, right? Along now with all the CRMs, all the ERP system available, right? You keep sharing information with your channel partners. Anytime a new customer gets, or you get an idea, right? You enter through a CRM, the customer relationship management software, right? There are many softwares where you can enter. Again, depends upon what kind of software you are using, right? But what basically this slide suggests is you have a central repository where information can be entered about customers, of what kind of products they are looking into, and it can be shared across your channel partners. So that information is transparent, and it is not only accessible to your sales team. Your plant manager can see it, your procurement team can see this, right? So now what you do, the sales forecast is not only by the sales team. It is, the estimates will come from all the teams. They will play a role. Your procurement manager will tell, let's say right now the big challenge for these automobile companies are in the electronic control board, ECB, whatever chips they try to use, that there is a shortage of chips, right? You might have a great kind of economic growth, there might be increase in automobile demand, but you know that you do not have raw material. If unless you have that chip, there is a shortage of chips across world. It is not only for India. Tata Motors is making a huge loss because they used to get those chips for Land Rover and Jaguar. So unless you involve those supply managers right now on that forecasting, because they are the ones, they will tell that there is a chip shortage and it will last for next 1 or 2 years. So you might forecast like anything, but you will not able to manufacture them because there is no chip. So your sales forecast will automatically come down, right? So that is where you have to, so that is where the collaborative planning forecasting will come picture, because once the supply team manager sees the forecast, for next year you have a sales forecast of manufacturing 10,000 automobiles or 20,000 automobiles. That is not possible because the cheap manufacturer, the raw material supplier who is supplying us those chips for our control boards, electronic control boards, they are telling they can maximum send us around 8,000. So my sales forecast can be 10,000, 20,000, but I'm not able to manufacture that many vehicles, right? So automatically it will come down. So that is where it makes sense to involve all of them: sales, marketing, production, logistics, procurement, logistics team. Let's say, yes, there is availability of raw material, but now COVID has happened, there is a restriction of importing material. So your logistics team will be able to give a clear picture whether how much they can import from different countries, how much kind of able to they can get from internal sources, right? So that is where all the functional members, functional team members, they give the logic of whether the target is possible or not, right? Because they have the access to that information. Earlier what used to happen, sales stimulate target, and after 3 months they'll say that okay, we need this kind of they'll send the target to plant manager. Plant manager will send the target to sourcing team. Sourcing team after 2 months, they'll come back and say that, okay, no, our chip manufacturer cannot give that kind of chips because they have a shortage of raw material. So that problem used to happen. Now, due to have a ERP system, you have a CRM system, you can share those information along with all your team members and they can provide you necessary input to correct your forecast, right? So that is where getting this kind of the method, collaborative planning and forecasting is much better than either qualitative or quantitative method, right? Because you are taking the not only from the sales team, you are taking the help from other functional team members. So basically fits into their your organizational needs, points out where plans deviate from their own, because plant manager will have their own plan, right? Plant managers will have, sorry, each year they might have 45 days or 60 days of plant shutdown for maintenance, right? So they can say that, okay, it is not possible to manufacture that many products, that many components in that month. So either they have to produce little bit of earlier or they have to postpone. Accordingly, your forecasting also will change. Think in this way, let's say Maruti, they are, or let's say this Bharat Benz or Tata Motors or also Cleland, they are supplying trucks to military. There will be demand from Indian armed force, right? But there might be possibility that in their also Cleland plant or Tata Motors plant, during certain months there will be a shutdown, plant shutdown for maintenance. So they might have to, the plant manager have to prepone the production. In some months they have to put overtime people and have to do that kind of manufacturing, right? So they need to get this data. What is your sales forecast as early as possible? You cannot just send month wise, okay, I need this month 2000, next month 3000, right? So now most of the companies use this kind of planning where all the people are involved, right? All the functional people are involved. And based upon those inputs, right, allows collaboration that assesses assumptions which may lead to different estimates. Because as long the assumptions are only from sales team or the sales force, that might be inaccurate, right? Once you take starting inputs from other team members, right, accuracy will increase. It might not be 100% correct, but accuracy overall will increase, right? Any questions on this? So generally, again, it is an iterative process. Some kind of companies do it 3 + 9 months. So next 3 months, then again next 9 months. Some people get into 4 + 8 months. Different companies follow different kind of iterations. So they fix a target for next 3 months, then the floating target for next 9 months, or they can be 6 + 6, fixed target for next 6 months, floating target for next 6 months, because depending upon the actual scenarios. Right now, there is a shortage of chips. Nobody knows when the raw material will be able to available, and they'll be able to supply actual number of chips to the automobile manufacturers. But 3 months down the line, situation might improve, right? So that's why the forecasting is a iterative process. Different companies follow different cycles: 3 + 9, 6 + 6, 4 + 8, right? So that is how they get into this kind of forecast. So there is no one best method. So that is where the earlier method works well. Qualitative, quantitative, taking help from different functional teams, having that transparency of information, right? Earlier forecasting, we used to be the sole area of sales and marketing team. Right now it is no longer there, right? So monthly meeting of sales, your plant manager need to be there, your supply chain manager need to be there. You have to take their input before kind of finalizing any kind of sales forecast. So that is where combination method works well, better than any single method, either qualitative or quantitative, right? And this is one example, like most of the B2B companies will have this kind of data. So this is known as something called as a sales forecasting or sales pipeline forecasting, right? So this is what, in case you join a B2B company, right? You will have in like kind of many copies of this file in your desktop. Sales pipeline 1, sales pipeline 2, sales pipeline 12, because this is what will be your bread and butter, right? You will keep updating that sales forecasting, right? So what it basically takes, so let us try to understand these numbers. That company which is supplying certain healthcare product to certain accounts, right? There are 5 big customers. What is the deal size? What is the in $1,000? What is the total? If they get that order, what is the deal size, right? So this is in $1,000, $10,000, 10,000, 20,000, 5,000. Then this is $15,000. ABC Bank, if they get that, is $15,000. So total deal value is $20,000, $19,500 after discount, after whatever information you provide, $38,000. $6,000 here. Here it is $15,000. Now the important part is at what stage of deal it is there. C is committed. Committed is basically your commercial negotiations are going on. That means you are at the final stage of negotiation. They just want to finalize the price. Then there is something called Q. Again, different companies will have different acronyms for this. Here Q is qualified prospect. Then there is something called B. B is for bid, at a bid stage, right? So you have participated in that tender. Lead is when you just have known about that opportunity, you are going to participate in that tender. Then what does this number suggest? This number is basically based upon your past data, based upon your matrices. You know that if there are 100 tenders, 100 deals you have participated in lead stage, your winning rate has been 5%. So if you get details of 100 customers, generally out of that, your final win rate is 5%. But if they have got into bid stage, that means you have participated in that bid. You were allowed to participate in that tender. Your win rate has been 10%. Then if you have qualified, you have technically qualified. That means you have whatever technical conditions, specifications they have put, you are able to achieve that. Your success rate has been 20% if you are at that stage. Final, if you are committed, that means your final negotiations is going on. 1 out of 3 tenders you have won. At a final stage of commercial negotiation, 1 out of 3 tenders you have won. Your success rate has been 33%. This is based upon your setting standard, based upon your past data, right? Then what does this probability means? This probability comes for the salesperson who is handling their account. That person who is handling this Z Life account, he says that he is 80% certain that he will win this deal. Then whoever person is handling this Y Life, he is 50% certain. So this probability comes from the sales team, the person who is handling that account. This is where somebody which is almost at a final stage, he is telling I am 90% certain, right? So this probability is a salesperson's own estimate of winning that bid, winning that tender, right? So why we look into this number? Think about in this way. Next year, let's say I do not have anything. I have only this 5 accounts. My company have only this 5 tenders where I have participated. So for 2022, I am going to create a sales pipeline. So sales pipeline means how much revenue I can expect and at what month, at what quarter. So here the months are expected closing is given. So that will give you the, so August means which quarter you have to, quarter 1, quarter 2, quarter 3. September means which quarter. So here almost all of them are in 3rd quarter, right? August, September, and other 3 are also in August. So that gives you a quarter wise and year wise what will be your revenue expectation, right? So that is your sales pipeline. So how will you calculate that? So let's say for Z Life, my total value size is $20,000. On $20,000, I'll multiply at what stage the tender is, at what stage of process, buying process we are in. So it is in C. C means committed. So from my past historical data, I know that I'm 33% certain that I'll win. So $20,000 multiplied by 33%. Then what does my salesperson tell me? Because I'm taking my historical data. So you remember what we discussed in the previous slide. So it is always better to do a combination, right? Take your historical data, historical quantitative information. Along with that, you take certain human judgment. My salesperson who is in field, he is telling he is 80% certain. My past data is telling 33%, but my person who is in field is telling 80% certain. So I'll multiply that with that. right? So 20,000 multiplied by 80% is how much? $16,000 multiplied by 33%. That will come close to $5,280, right? Similarly, if I take another example, it's the last one, $15,000. At what stage this tender is? That is in B, that is bid. So that is 10%, right? And what my salesperson tells, he says he's 40% confident that he will win this bid. So 15,000 multiplied by 40%, that is $6,000. $6,000 multiplied by 10%, that is $600. So total, I'll calculate for all the accounts, and I will have a next year Q3. I have a sales pipeline of 14,390. So all this, so that target each of the salesperson will have, and that will be with the company CEO or CMO. So they will have hundreds of lines in the Excel or whichever software they're using, right? And they'll keep monitoring that. They'll keep adding new customers. And one most important aspect of that pipeline is the timeline. When do you expect that deal to close, right? Because that will give you an idea that, okay, whether I can take that estimate for next year or year after that, right? That again has to come from the sales team. Any doubt on how this being calculated? Anyone having any doubt on this? Because your class exercise is just this. I have given certain information, you have to calculate your pipeline value.
So the 80% value of from the value is how can we calculate got to the final value, that is 5,000. If you take the first example, then
Yes.
20,000 and probability is 80%. Then how we get to the value of 5,280?
20,000 multiplied by 80%, that is 16,000, right? 16,000 multiplied by, so you have to look into at what stage that bid is. So that is in committed. So that is multiplied by 33%.
Okay, so that stage is defined there. Okay, sorry. So that means we have to multiply the probability as well as the stage as well.
Yeah,
Then we'll
yeah.
get the total
Yeah.
value. Okay, sir.
So,
Thank you, sir.
so in some companies, they just take the idea from, so if I just want to take a Salesforce composite, so I'll not consider my past information, right? So that is only will be qualitative. So I'll take the information from the sales team. I'll not at all consider the whatever is written in the bottom. So what will be my estimate? 20,000, 80% is 16,000, my pipeline value. So that is if I get into this qualitative mode. If I purely want to do only quantitative, I'll not take human judgment into picture. So what will be my estimate? 20,000 multiplied by, let's say C is committed 33%. That is around how much? 6,666 around. But pipeline forecasting, most of the time they consider both. They take human judgment where the sales team or the salesperson will tell how much confident. So these basically probability is confidence, right? How confident they are that they will win that bid. And the bottom, whatever information is given, that is your based on your past data. In earlier last 10 years or 5 years, whichever tender was there in lead stage, whatever has been your win rate. Those tenders who are in commercial negotiation stage, what has been your win rate, right? So now what you are doing, you are considering both of them, your past information, historical information, and your whatever confidence your salesperson shows, right? So that is why it is little better, little conservative, but little better than doing both of them independently. Is it clear?
Yes, sir. Yes, sir.
Okay. Anyone having any doubt? Because like I mentioned, your class exercise which you have to complete is only thing you have to calculate sales pipeline. I have given